So normally with the presentations, we start with the definitions. As I say, I'm not going to run through it, but there are questions about definitions. And I'll get to that towards the end. We can go through that. But you've got to know what economics is. You've got to be able to describe or define economics. You've got to be able to define microeconomics and macroeconomics and know the difference between macro and micro. Maybe in some of the true and false questions or the multiple choice questions, you'll be given a statement, and you've got to recognize if that statement is for microeconomics or macroeconomics. So definitions are important. There are 16 marks in the exam on definitions. Okay. And I just want to say, if I go along and anybody has a question, please feel free to ask at any time, and we'll discuss it. All right. All right, the economic problem, I think you people have worked through the semester. That is the basic problem. It consists of the three parts. It's needs, it's means, and then it's the choices by consumers and also by the producers. There's some more needs, individual needs, community needs. This is actually self-explaining, so I'm not going to go through that. The economic problem continues. The limited resources comes in the fact that there are natural resources, capital, labor, and entrepreneurship. So you've got to just go through the presentation and make sure that you understand what that means. Products, goods, and services is classified normally, and there are questions on the different types of goods and services. So we're going to start by economic goods and free services. You've got to know what that is. So I suggest take this presentation. It has been posted, it has been given to you. I think mostly everything you need is in this presentation. So go through this and look at what the definitions are. Economic goods, free goods, intermediary goods. We're going to get to all that now. Opportunity cost. You have to know what opportunity cost is. If you think in economic terms, it's the value of alternative opportunities being forfeited. So that means if you take your money and you buy something, it must give you the same or a better return as what you can buy something else with. So it's the value of alternative opportunities that's being forfeited. That is the definition of opportunity cost. And it explains there, when there are more than two alternatives to choose from, it is the next best alternative foregone. So you can only invest in one alternative, and it must be better than the other one. Otherwise, your opportunity is gone. That's what opportunity cost means. Everybody still with it? Okay, good. And then we get to the PPC curve. Now, in the exam, there are always questions about this. I'll tell you later how many marks, but there are at least 12 or 13 marks on the PPC curve. You've got to be able to define the PPC curve. There's the definition there. It indicates the combinations of any two goods or services that are attainable when resources are fully, it actually should say they're utilized. So just look at the definition. You can get it in the study guide as well and in the textbook. But look at that definition and make sure that you can understand that definition. Now you've got to illustrate with a graph what the PPC curve looked like. I'm not going to give you specific values like I think what this lady's got in the presentation. I think it's on the next slide. I'm not going to give you values and expect you to draw the graph. I merely want to see if you understand what a PPC graph reflects. Okay, so this you can go through in your own time, and if you go through it, it will make sense to you that there's pillows and there's blankets. Now, if you give up some pillows, you can get more blankets, and vice versa. So that is what the PPC curve means. PPC curve, just remember that the axis on the PPC curve is always between two goods. Let's take pillows as product A, and on the x-axis, you'll get the blankets. So PPC curve is different to a supply and demand curve, which we'll get to. It's about two products, any two products. pillows and blankets is just an example. You can call it product A and product B. All right, so we're going to get to the curve. This is what I want you to know for the exam. We're going to work with pillows, yeah, and blankets, 2 products, okay? Could have been a quantity of product A and a quantity of product B, so any 2 products. There could be a question in the exam about 2 products, not pillows or blankets, but something else, maybe meat and butter or something like that. Okay, so it can be any 2 products. Just read the question properly, and when you draw the curve, make sure that you put whichever product on the y-axis, which is this axis, and the other product on the x-axis. And the curve will normally tell you which of the products you must put on which axis. It will tell you to put pillows on the y-axis, and it will tell you to put blankets on the x-axis. But just remember, it could be other products, not necessarily pillows and blankets. Okay. Yes. Yes. You've got to be able to draw this graph. Yes. We'll go through the explanation. What's important with this graph? Sorry, I don't want to stand with my back to you guys. Just shout if you can't hear me. I'm trying to talk loud. Eh? All right. My voice is soft, so stop me if you can't hear, and then I'll explain. PPC curve, as I say, it's 2 products on the y and the x-axis, and there is the PPC curve. We'll get to the qualities of the curve just now, but this is the normal shape of the curve. It's convex. That means the curve runs from the 0 point of the graph, from that point. It runs away from the 0 point. So that shape is what we call concave. You'll see when we get to the indifference curves, it's just the other shape. It's a convex. It runs towards the origin, but let's focus on this one first. So the PPC, firstly, the PPC curve is concave. I'm just going to go to the next slide. There you'll see what I've said before. The PPC data, it illustrates the combinations of 2 products. So if you ask what are the attributes or the characteristics of a PPC curve, this is what you have to put down. It's combinations between 2 products. It's concave. That's that shape I showed you that it runs, and the curve and what the curve illustrates. There could be a question asking you, what does the PPC curve illustrate? Now, this is what it illustrates. It's opportunity cost, moving from point A to F. I'll just go back to the graph. There's point A and there's F. Now, there's pillows. Now, if you move from point A to F, you give up pillows as you move along. See, there's 50 pillows. If you move along that curve, let's say at point D, you're going to get about 35 pillows. But as you move down on that curve, you give away pillows, but you get more blankets. So that is what the PPC curve represents. It's opportunity cost. If you give up some pillows, you get more blankets, and vice versa. Okay. Now, what you know, what's important on this curve, and there are questions about this, is where these points are. Point K, as you can see, you can call it any point, but point K, which lays inside the curve, it represents the combination of the 2 goods is attainable, but it's not efficient, because you can see at point K there, you can get 20 pillows, and you can get 1 blanket. But on the curve, you can get 45 over there at B, say for instance, you get 45 pillows for 1 blanket. So here's only 20, so it's not efficient. You can get, if you stay on the curve, you can get more pillows.
But you also mentioned that it's not efficient.
Yes. You've got to look at that. That is, yeah, point K is attainable but inefficient, and it represents normally unemployment. That's not so important. The first 2, it's attainable but inefficient. Okay, and then anywhere on the curve is efficient, and it's your choice, and you can move anywhere on that curve between pillows and blankets, and it will give you the same combination. All right, and then so you've got to know opportunity. The efficient part is on the curve, inefficient part is below the curve, and then anywhere outside the curve, like point L, there's scarcity and it's unavailable. So that's what you've got to remember. There are questions about this, so take note of this. We've been through this slide. So the curve A to F illustrates opportunity cost. It's moving from point A to F, represents a decrease in pillows and an increase in blanket production, as I said. Everybody understand that concept? Point A to F also illustrate the productive allocation of resources, the inputs, labors and machinery. We'll get to later stage, we'll get to that. Points A to F also illustrate the maximum combination of the products. Any combination, as I said, on the curve you can achieve, and it's the maximum. That's why it's efficient. Okay. And it's, like we said, it's the most efficient combinations on the curve. Point K, we've gone through that, is attainable but inefficient. That's the one inside the curve that we showed. And unemployment, you don't have to worry too much about that. Just remember, it's attainable and inefficient. Point L represents, okay, we've gone through that, unattainability and scarcity. Let's just quickly go back to the curve. So K is attainable but inefficient, and there's point L, scarcity and unattainable. And then I just want to stress that anywhere on the curve is efficient. It can be any combination between pillows and blankets or any products, product A and product B. So if you stay on the curve, then you're efficient. Okay. Then we've gone through that. There's point K and point L, we've gone through that in detail. Now this is what I also want you to remember. There could be a question about this in the exam. Say for instance, that curve that I showed, A to F, let's assume it's this curve over here. Now how do you get the curve to swivel? Sorry? How do you get the curve to swivel? This original PPC, which is this one here, can swivel. This is what you call a swivel of the PPC curve. Like you may be asked to illustrate how does the PPC curve swivel. And a PPC curve can swivel if you keep one, this could be pillows, but here we call it consumer goods. Remember we said we could use any product. Say for instance this was the pillows. If you keep the production of pillows constant, it doesn't change, but there's something that causes the curve to swivel. So the capital goods, or it was blankets on the other one, from B to C. Now the factor that can cause the PPC curve to swivel is there's an improved technique in the producing of capital goods. You understand? So if there was, for instance, an improvement in pillows, forget this one now, then this one would have stayed constant, but the curve would have swiveled up to there. So then you would have had a swivel that way. So then there was a improved technique of producing consumer goods, or it could have been pillows as well. You're right with it. Okay, so if you've got to illustrate where a curve swivels, then that is what you've got to show. But as I say, it could also swivel the other way. I think the next slide, so this is exactly what I said with the previous slide. So if you want the curve to swivel the other way around, like I showed, then there's an improved technique for the producing consumer goods. It's exactly what I said. So you can illustrate the swivel of a PPC curve with these two graphs. You may be asked, what if consumer goods, there's an improved technique, then it will move from A to D. There will be a swivel to the top, and that one will be constant. All right. Then you can also get that same PPC curve that we had from A to F. You can get it to move parallel, shift parallel outward. That's what you call a shift of the PPC curve. Remember the other one was a swivel, and this is a shift. Now a shift can be caused, if you can remember, we had a point, I think it was L, that was unattainable. Now the only way, in that other slide I showed, the only way to get to point L, which was, it was not attainable, it was the ultimate combination, but it wasn't attainable. The only way you can get there is an outward shift of the curve. And the only thing that can cause that is if there's an increase in the productivity of all the available resources. So you can increase the amount of A and you can increase the amount from A to F in consumer goods and from B to F in capital goods. So there's a swivel that you can get, or you can get an outward shift of the curve. That's the difference there. And that is questions that may be in the exam. So just go through the presentation. If you don't understand, you can always contact me and I'll explain to you, or you can come and see me. All right. Okay, this is just basic stuff. This is stuff that you can read through and it will make sense to you. So goods and services, goods are tangible, services are intangible. I'm not going to go through this. Services are intangible, things such as medical services, legal services, etc. Goods are tangible, you can touch it, like food, clothes, bricks, etc. So just go through that. There may be just short questions on this, but not particularly on this. All right, not particularly on this one. Okay. I'll just give you some tips as we go along. Are you happy about it? You look. Okay, then I'll stand here by you. Okay. Okay. So you don't have to panic. Don't have a mental block. It's not so difficult. The paper is not. If you listen carefully tonight, you'll pass. Okay. Who's here for the second time? Okay. We're going to get you to pass and pass well, eh? All right. But if you don't understand, you would rather contact me before the exam. Okay. So what I was saying here is, did you understand this part? Where the curve can shift outwards. You wrote down? Okay. Then I said, the allocation question of what should be produced. Then this is just an indication of goods and services and what the difference is between goods and services, all right? So, but there's not particular questions about it. If you read through this, and there are short questions, you'll recognize it. Okay. Now, this is some of the definitions, as I said. There's always definitions in economics. Now, these definitions, you have to, it's just a matter of studying it and understanding it. If you don't understand what that means, you can contact me. But if you go through that, consumer goods is used by consumers or households. Capital goods is goods that are not consumed, but it's used for production. So that makes sense. Consumer is what you buy, and capital goods is what the producers use to produce the stuff. But you'll see as we go to different goods, there are a lot of definitions. So just make sure you go through all of them. At the end, I'll give you a little bit more, and I'll narrow it down a little bit for you. Okay. Still, classification of goods, you get non-durable goods, you get semi-durable goods, and durable goods. If you go through that, you'll understand what it means. I'm not going to explain it now. You must study it, and that tells you exactly what it is. So that is stuff you can study. Now, there could be definition questions on these. Okay. Then you get final goods versus intermediary goods. Final goods is goods that are used or consumed by individuals, enterprises, and households. That's a TV or a car. That's a final good. An intermediary good is goods purchased by the producers to manufacture a car or a TV. So that's the difference between those two. You may be asked in a true and false question, given a statement, between final goods and intermediary goods, and you've got to recognize the difference between the two. Okay. Private goods and public goods. Private goods, it's goods that you and I consume. Public goods is that it's free for everybody. It's like traffic lights, defense, public roads, that's public goods. There are not a particular question about this. Just read through it so that you understand going forward. I'll rather say focus on the previous slide for definitions or descriptions. This slide, just know what it is, because you use it later on. Economic goods versus free goods. This could be a question also. You could be asked to describe any of these two or recognize the difference between the two. Okay, so go through these slides and study these definitions. You can get a lot of marks if you just know the definitions. 16 marks. It's a big part of the exam. Then homogeneous goods and heterogeneous goods. As we get on later, what homogeneous goods mean is it's the same. And heterogeneous goods means it's differentiated, different types of goods. So homogeneous is the same, heterogeneous is different. So just know the definitions. There are the definitions. So if you ask the definition, give that definition. Study it. You write it out for yourself a couple of times. Make sure you can write it down. Can you hear now?
Yes,
You can hear.
I just want to know what means study everything about classification of goods. Because I see there are a lot of them.
Yes. As I said, later on, I'll just narrow it down a little bit for you. Okay. Then, normal goods versus inferior goods. There are a question about this in the exam. I can tell you now. You've got to know what inferior goods mean. And this is, we're going to get to elasticity, but a normal good are goods with a positive income elasticity. We'll get to elasticity later. But if you ask to define what a normal good is, that is the definition that you've got to give. And the difference between a normal good and an inferior good is that inferior goods are goods that have a negative income elasticity. So those two, you must know the difference. We'll get to elasticity and I'll explain to you how that works. As I say, it will be discussed later on the elasticity. This is self-explaining. Normative statements, it's opinions. It's, this is anybody can make a statement. And a normative statement can be anything. Like I say, Messi is a better football player than Ronaldo. People will differ about it. You can't prove it, you know. That's what a normative statement is. And a positive statement is things that you can actually prove with statistics and with facts. Global warming is taking place. We all know that. And the economic growth rate in SA for this year is a certain amount. The Reserve Bank published those figures. So that's what a normal statement means. Then, okay, that's study unit 1. So what I suggest, go through the study presentation when you go prepare now for the exam. And if you have questions, please come and ask me. Don't wait till the last. As you go through it, ask me. And I'll always, I think students have seen in the past that I'll always try and assist the best I can. All right. Study unit 2 is about economic systems. That's also not a difficult unit. And I can say there's no long questions about this. It will only be in the true and false or the multiple choice questions on the study unit. So that is what is important there. You may be given a statement about economic systems, and you've got to differentiate between the various systems. Between a traditional system or a market system or a mixed system or a socialistic system. Just know what those are. And under this economic systems, that question that we had earlier of what, how, and for whom you must produce always comes to play. But for exam purposes, just focus on the differentiation between the systems. Now, just briefly, the traditional system. Hello. Sorry, will you mind sitting here if you don't mind? So will you mind to sit here so that you can hear me? All right. Okay, just briefly for your sake, briefly for your sake, I just want to say we went through study unit 1. We've just started with study unit 2. And if you have the presentation, study unit 1 gives you everything that you've got to know for the exam. Okay. If there are questions, just send me an email. Okay. So a traditional system, that's self-explanatory. People produce per tradition. They produce for themselves. But the problem with that is that it can stagnate you. You can't go much forward. You just stick to a certain tradition. Okay. And the command system, it's a socialistic system. It's a centrally planned system like Russia, for instance, and public ownership of all the factors of production. So the state decides exactly what needs to be produced, how much, and they distribute it amongst all the people equally. So the main attribute of a socialism system, it's a centrally planned system. So in a true and false question, you may be given a statement saying the command system is a decentralized planned system. And then it's false. Because it's got to be a centrally planned system. You've got to recognize that. Everybody okay? Yeah. And then we get to the market system, the capitalistic system. That's a pure capitalistic system. South Africa has got a combination, as you'll see, between a centrally planned system and a market system. Now the market system, there's large numbers of buyers and sellers that you get by us. There's an interaction of demand and supply. We're going to get to that just now, which determine prices. There's private ownership of the factors of production. Remember, under a socialistic system, the government owned all the production factors. So just learn the attributes of a capitalistic system. And then there's a mixed system. That's South Africa system. Decisions are made partly through the market and partly through the government. I think we all know that. South Africa has got a typical mixed economic system. So that is the most important part of all the systems. That you've got to understand that South Africa has got government planning. Come in. Sorry? Yeah, it's this one, eh? Can I maybe ask you to sit here? Can I put another? I'll tell you why, because I don't talk too loud. So I want you to sit here. See? Okay. That's fine. I'll move my stuff here for you. Yeah, if you can just sign the register for us, all right? Okay, just for your sake, and the lady that came late, we've done study unit 1, and it's all in the presentation. Everything you need to know about study unit 1 is in that presentation. So if you go through it, and there's something worrying you, you must contact me, all right? We're on study unit 2 now, which is market systems, and I said that there are no long questions on market systems. It will be more on the shorter questions like true and false or multiple choice. So for the mixed system, decisions are made partly through the market and partly through the government. So that is the main attribute of a mixed economic system. And the factors of production are in the hands of both private and public. Okay. So of all the systems, know this part here. That you recognize and you know what it's about. Okay. For exam purposes, I said I will give you some tips about the exam. So just know this slide. This is slide 22, I think. 32, I can't see so nicely. So, are you two ladies okay? Sorry? The aircon. Yes, I wonder. You're going to get hot. Let me put it off. Shall we try this? Okay, is that better now? Much better, okay. Great. Okay. So, as I said, this slide is important for exam purposes. Then, study unit 3. So, study unit 1, most important was the PPC curve and the theory and where the points lie on the PPC curve, what it is, the shape of the curve and so on. Study unit 2 was about systems, and the most important was that last slide about the mixed economic system that South Africa has. Then we go on to study unit 3. In previous papers, there have been very complicated flow diagrams. I can assure you in this paper there's not one. We are just going to, I may give you something small in a short question about it. So you don't have to, when we go to the very complicated flow diagrams, you don't have to memorize that. But it's important for yourself to just go through it and see how the flows work through an economy. That is important for you, because if you carry on with DEC 2A or ECO10A, and that becomes important for you, all right? But for exam purposes, I'm going to give you a basic question about flow diagrams, all right? So the basic flow in the economy, the basic flow between production, income, and spending are these three major flows in the economy. That's between production, income, and spending. So producers produce, and it's a self-fulfilling flow. Producers produce, that creates income, they sell the products, and they spend again, and then it flows back to production. So that is the three major flows in the economy. You may be asked, given a diagram, and say what that diagram represents. And you must know that it's the three major flows in the economy. So all the next slides are based on production, income, and spending, and the flows in the economy between those concepts. So a stock variable and a flow variable, that's the difference between the two. A stock variable is measured at a specific time. For instance, capital is a stock variable. And a flow variable, it measures quantity over a period of time. So a stock variable measures at a specific time, and a flow variable over a period of time. That's the difference between those two. Now, there could be questions about this as well. So you can maybe just make a note. Can I just see the number of the slide? 34. Okay, slide 34. Unfortunately, that little, I can't see exactly, so I'm just going to look by this lady what the slide number is. So slide 34 is important for you. Then this is just a little bit more complicated flow diagram. Once again, it's the blue is the flow of money, and the black is the flow of goods. Now that's from households. Now households spend on the market for goods, and they buy things in the market. So that's why the flow of money goes from the household to the market. So from the market, it flows back to the producers because they buy from the producers. And again, from the producers, they've got to buy stuff to make the products, and that's why it flows back to the market of production factors. And from that, they buy labor, for instance, and that's why households get income, and they can spend again on the goods and services. So the flow of money is the blue arrows. Just make sure that you get the directions of the flows right. In the short question, you could be given a diagram like this one, and the flows, the arrows are different way around. Then you've got to say if it's correct or true and false or not. You understand what I'm saying? Okay, so the flow of goods is by the black. Sorry? In blue, yes. There it tells you. Eh? So just work through it yourself, and it will make sense to you. Because as I say, people, households, that's you and me and anybody else. spend on goods, and that the market get money and they spend again, they buy from the producers. That's why their money flows to the producer. And from the producer, they buy inputs to make the stuff. And then it flows back to the households because they also buy, for instance, labor. And we are all paid for work, and that's why the money flows back to the, so it's a flow all the time. But just note that the flow of goods is the other way around. So you must start with the flow of goods. It's better to start at the market because the goods flow to the households. They sell to the household. From the household, it goes back to the market of production, the production factors, and from there it goes back to the producers. So just this diagram, just look how the flows go, and the blue and the black, what the difference is in the flow, the direction of the arrows. It's just important that you know that. Could be given a diagram like this one where it shows the flow of goods, the arrows the other way around maybe. And that one, the blue one, that way, then it's false. You know what I mean? So just, this slide is also important for you to know. The same with this slide. You could be given this slide, and you've got to show the arrows. It's very, very much the same as the previous slide. But it's from firms in the goods market, the income to the firms spend on the factor market, and factor market labor, and that goes to the households, and from the households they spend again to buy goods. So you could get a diagram like this with the arrows the other way around, and then it's false. So just take note of that. You won't be expected to draw this, as I say, this time. Okay. Then, as I say, for that lady's sake, you'll be given a graph. You just got to recognize that the flows are right, and between the households and the factor market and the producer, and so on. Okay. So that's the definition of households and the definition of firms. So households represent demand in the economy. The next slide will explain that to you. And firms represent the supply in the economy. That's quite obvious. Now, if you look at the next slide, there we've got the flows between firms and households all the time. But there, now we're going to start with supply and demand. There's the goods market with the supply curve and the demand curve in equilibrium. Now, remember, firms represent the supply of goods and services, and the households represent the demand of goods and services. So if you're given this diagram with households on that side and the arrow like that, or firms on that side with the arrows like that, then it's not right. You've got to know it flows to the good market and which way it flows. Now, these flow diagrams, I just want to repeat it. In this exam, there's not a question where you have to draw complicated flow diagrams. You've just got to recognize how the flows in the economy work. That's the basis of it, okay? And this one is exactly the same. If you go through it, I'm not even going to go through it. It's exactly the same as the previous slides. It's just in a different format, but it shows you how the flows work. This specific graph, sorry, that one, is not in the exam, but it just says what the previous slide told you. And this is a very complicated graph, but it tells you exactly the same again. You won't be expected to draw this, and this slide also it's a short question, so this is too complicated for a short question. Okay, but it tells you it shows you with the government in the inside. Remember, we said it's a centrally planned or a mixed system. Some in the government, so the government's in the middle, and how the rest of the economy focuses around the government. So you'll see there's government spending out to the goods market, to the factor market. So just look at the flows, and you'll see that it will make sense to you if you go and buy stuff, how money flows, and if you're a producer, if you work in a producing plant, how the money flows. You buy inputs, produce the stuff, you sell it to the market. So we just want you to understand the flow in the market. Okay. And this one is the same graph. It's just with the foreign sector. Um, this graph is important maybe. Foreign sector included in the circular flow of production, income and spending. So you've got to recognize the firms and the households and the foreign sector, how it impacts. The foreign sector, normally the payments flow, the firms import and there's a flow to the foreign sector. And the households from the foreign sector, it's payment for the exports and so on. So these two arrows are important in this slide. That you may be given this slide and you've got to know that the foreign sector, the flows are from the firms to the foreign sector, from the foreign sector to the households. So if you think back, I'm just going to go 2 slides back. Firstly, we've incorporated the government in the circular flow of production, income and spending. Then we've incorporated the foreign sector in that same production, income and spending. And now we're just incorporating the financial sector. That's the banks and so on. So between the firms and the households, the banks play a pivotal role. There's money flowing all the time between firms and households and the banks. Okay, I'll get to that later. I'll give you a little bit more tips when we talk about the exam questions about this specific part of the presentation. Okay, we stay now with production, income and spending. I want you you must be able to recognize this formula here. This is the formula. This is total expenditure. You've got to know what the formula is for total expenditure. That's on slide, was it 44? Eh? So you've got to know and you've got to recognize that's consumption, that's investment, that's government spending, that's exports and that's imports. I'll come to the breakdown now, but that formula, that's the formula for total expenditure. And you may be asked to write down the formula, or you may be given the formula. Remember I said there's no long question, so you won't be asked to write it down, but it could be a true and false question or a multiple choice question, this specific one. So I'm just going to go, you've got to know what the symbols stand for, and I'm going to go back to the previous slide. The C stands for spending by households on consumer goods. And the I is spending by firms on capital goods. That's the investment part. And then spending by government on goods and services is the government spending part, the G. And spending by foreigners on South African goods is the exports, that if we export overseas, then the foreigners buy our product. That's where the money flows. It flows from the foreigners paying South Africa for the stuff that they import. South Africa imports, but the foreigners exports, but the foreigners import from South Africa. Okay, so X is exports, and then imports is spending by South Africa on imported goods if we import from overseas. So that formula always takes the net of exports and imports. I'm just showing you what the X and Z stand for. So in that formula, it's the net between exports and imports. So you deduct the imports from exports to get that figure. But for our purposes, let's just know what this formula is and what the symbols are standing for, or representing. And that's given to you on the previous slide. Okay. In this formula, you must just know that there are taxation. We're all paying tax. There are savings. We're all trying to save. It's not always possible with a high petrol price, but we're all trying to save. And then imports is important in this formula. So you could be asked, given the formula, and they're going to ask you what is the most important concepts that you need to know that has an effect on this formula. And that's taxation, savings, and imports. So that is a leakage or a withdrawal out of the system. We because taxation we pay, savings we also pay the banks, and imports is we pay overseas people to get the goods. This is a summary of all of those. There's the government, financial sector, and the foreign sector. Once again, you won't be expected to draw. In previous exams, students have been asked to draw the diagram, but this time not. I'm going to focus on other aspects in the presentation more, and only short questions on this. Okay? And once again, for your own sake, this is a good explanation of how it works. You won't be expected to draw this diagram, but it shows you exactly how the flows are. And if you go sit and look through exactly how the flows are, it will make sense to you. Okay? Then, so study unit 1, 2, and 3. Study unit 2 or study unit 1, the most marks comes on the PPC. Then study unit, I can't remember, it was in the definitions of the different types of goods. That's important. So the most, PPC is like 13 points, PPC curve and theory, and that I've said in the slides. And the definitions counts, I think, 16 marks. So that's already almost 30 marks of the exam. So if you know those two, it will help you a lot. Okay. Then we get to study unit 4. This is supply and demand. Has everybody handed in their assignments? And how did you find it? No, we're still marking. That's why I'm so tired. No, but yeah. Did you get the answer sheet? Yes. Okay. So you know more or less what you've written and what it should look like. Go through that again. So in supply and demand, there are always questions about supply and demand. And it also counts in this exam, it counts the most. And it's not difficult. We're going to go through it quickly, what's important. Remember in the assignment you had a application question where you, between bread and flour, how you had to draw the curves in that. There could be a question like that, but with different products. So what's important to establish there is if total supply change or if the price changes. So when we go through it, I'll try and explain to you what is important there. So once again, for the definitions, this could also be part of the definitions that I said, Nana, is the definition of demand. This one you always have to know. This you can read. It's not so important. What's more important on this slide is the definition of demand. And you definitely have to know what is the law of demand. I think there was a question in the assignment on this. And it's always important if you give the definition to say with all other things being equal, or ceteris paribus, that's what it means. To complete the definition for 2 or 3 marks, you have to include that. So the law of demand is that if the price goes up, quantity goes down and vice versa. So this is important for definitions. Once again, I'm not going to expect you to give you a table like this and expect you to draw a demand curve for me. I want to see if you understand what the demand curve is and what it looks like and what quantities and prices you can determine from that. So this is just to basically show you how the demand curve comes about. There's different people, Anne, Helen, Purvey, 3 different people have different demands, and then the total demand curve or the market demand curve is derived from what everybody wants, and then against the price of the market. As you all know, supply and demand is always the price on the y-axis and the quantity on the x-axis. Remember with the PPC, don't get confused, the PPC curve was between 2 products, product A and product B. So don't get confused with the axis. And always name your axis on the graph because you get marks for that. Okay. And that's what that curve looks like. That is a typical demand curve. Now, I just want to stress the fact that if a demand curve, if you asked what is a linear demand curve, the definition is you say it's a demand curve in a straight line. And if you ask to illustrate a linear demand curve, it's this curve, but for safety's sake, a linear demand curve normally runs to the axis and to the axis. So that is basically just what a linear demand curve is. So it touches the y-axis, the price axis, and it touches the quantity axis. So there could be a question on that. That's why I'm giving you just tips. Learn in your study material what is a linear demand curve for a few marks. Okay. Then there's the individual demand curves of those people that we had earlier on. Those numbers there, the slide, the graph for them is all different, and the values in that table you'll find out there, but I'm not going to expect you to use it, but you can see from the values how that's derived, and then this is the total demand curve for all the people in the market. Okay, it's just a concept. So it's important, see still even in the assignments that students get confused with the demand curve and the supply curve. They show the demand curve where the supply curve must be, and they show the supply curve where the demand curve must be. So please don't get confused with that. You have to know how the demand curve runs. And then you have to know what the linear demand curve is, as I said. Okay.
Which one between the two?
Sorry?
Is the other one, the demand curve, they say illustrate the demand curve. Which one is the
That one. If you ask to demonstrate, or if you ask the definition of a linear demand curve, all you have to say is that it's a demand curve in a straight line. You can draw a demand curve like that, or you can draw it in a straight line. Now, a linear demand curve is a demand curve in a straight line, but it normally touches the two axes. So if you ask to illustrate what the linear demand curve is, you draw that where the demand curve touches the axis. Okay. Then yeah, that's easy to answer because that's the individual demand curves, and all of those make up the market demand curve. So that's the market demand curve. The market demand curve is the sum of all individual demand curves. Then this table is important for you to know. And what's important with this table, it looks difficult, but it's not. In the exam, in all economics, they're always asked, what is the movement on the demand curve and what is the shift of the demand curve? So you can make note of that. It's going to be in the exam again. So make sure that you know what that is. And in this table, there's the determinant, there's the change, and there's the effect on the demand curve, and there's the correct description of the effect. So you may be given a table like this. This table explains it upwards or downwards. It could be just one direction, not as, both of them. But what's important to know, a movement on the demand curve. If you look at this demand curve, a movement on the curve is always from one point to another point. You always got to show it like that. B and A. That represents a movement on the demand curve. And the only thing that causes a movement on the demand curve is the first determinant, the price of the good. That's the only thing that causes a movement on the demand curve. The rest of these determinants all cause a shift of the curve. We'll get to that now. But remember that the price of the good causes a downward or upward movement on the curve. Okay. And then that is called, it's an increase or a decrease in the quantity demanded. So the first one is differentiated from the rest. The first one has what to do with a movement along the curve or on the curve, and it's called a change in the quantity demanded. Where you'll see the rest of it is a increase or a decrease in demand. There's a difference. We'll get to that just now. So this one is separate, and all of these are separate. You can maybe be asked in the exam, what factors causes a shift of the demand curve? Then you must give this. The prices of substitutes and complements changes. Now there's a difference between the prices of these and the price of the good. These are different goods, the substitutes and complements. So it's prices of related goods causes a shift of the curve. You see a shift. All of these are shifts, as you can see. Shift, and that's the only one, top one, that's causing a movement along the curve. Okay, so there are questions on this. Make sure you understand it. If you don't, you must please contact me, and I'll try and explain to you in better terms. Or you can come and see me. I'll make time to speak to you. Are you okay? Yeah. Okay, so this table is important. You may be asked, what causes a movement along the demand? In a table, show what causes a movement on the demand curve. Then it's the price. And what causes the demand curve to shift? And these are all the things that causes it to shift. So there are long questions about this. So your income of the normal good, your taste and your preference, the population. You can think if the population grows, then there's an increase in demand, obviously. That's why it causes the demand curve to shift totally up. And expected future price of the good. This is the important one. So you get the prices of the related goods and the expected future price. So for instance, in a practical question, if there's a drought in the country and you expect the price of maize to rise, that's your expectation of the future price. That will cause a total shift of the demand curve. But if the price of the good changes in the market itself, if say the price of bread goes from, what's bread now, say 13 Rand to 18 Rand, then there will be a fall in the quantity demanded because people don't want to pay so much. I'll get to the graph now in a minute. But just take note, and the same goes for the supply. I'm not going to go through the supply in detail, but these two tables for demand and for supply is important for you to understand. Just work it out for yourself and see if you understand it. If you don't, please contact me. Now, if you're asked in the exam to explain the difference between a movement on the demand curve and a shift of the total curve, I think I did send some video clips from overseas presenters about this on the study group or the subject group. Did any of you see that? To show you the movement and the shift. Okay, so this one is the movement on the curve, as I said earlier on. So price causes that. You're going to be asked what causes a movement along the demand curve. And then you must say to me the price of the good. The price. Okay. And if you asked what, this is an illustration, a graphical illustration. You may be asked, I think in the assignment it was like that. You had to illustrate how does a movement on the curve look. And this is it. So you always label your axis price and quantity. And you show the demand curve, and you show that there's a movement on the curve. And you must note that if the price changes, let's say for instance the price changes from 12 Rand to 15 Rand. I took bread, I think I said 13 to 15 Rand, but let's say 12 to 15 Rand. So the price increases. What happens to the quantity? The quantity will come down from 200 to 150. And you must show it like that if you ask. That will show you understand it. So price and quantity changes, both changes. And that is a movement on the curve. Okay. Where if you get a shift of the whole curve, it's all these other determinants that we had here, all of these, causes a shift of the curve. There it tells you, just go and work through it. There's shift, 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 and there's a movement along the curve. So if you ask to graphically explain how a shift of the demand curve works, how it looks graphically, then you draw the same diagram with price here and quantity there, but then obviously your curve shifts out. There's no movement on the curve, it's a shift out. And what you must note here is that with a shift of the curve, the price was the only factor causing the movement. Here the price remains constant. It doesn't change, but the quantity changes. Quantity changes from Q1 to Q2, for instance. Are you with it? Okay. So I'm going to rub it out. This is not so difficult, really. If you go and sit and draw the little diagrams for yourself and practice them a bit, you'll see. Okay. Let's carry on. All right, this is an illustration of both, but I would prefer if you do them separately, if you show the movement separately, and if you show the shift, that's the movement on the demand curve, and that's the shift of the demand curve. And once again, just to note that with the movement on the curve, it's price changes, so there it shows change, and then the quantity changes. Where there's a shift, the price remains the same, but because the population grows or the expected future price, you expect it to be more, then the whole quantity moves to the right. Okay. So this one is just those two graphs put together, but this could be confusing. If you know what you're doing, you can draw this, you'll get marks, but it's much easier to draw them separately and explain them. Yeah, okay. All right. Then we get to supply. This is very much, can you hear me? No. Then just like the two goes hand in hand, as you know, supply, sorry. The two goes hand in hand, supply and demand. This is just about supply now. So this whole chapter is about demand and supply and the practical application of demand and supply. We've done demand, now we get to supply. So you've got to know what is the definition of supply. You always get that. You get it in a multiple choice question or a true and false question, or you have to define it. And as we said earlier, supply is linked to producers and supply is a flow concept. But focus more on the definition for exam purposes. And the law of supply is just the opposite to the law of demand. If the price rises, all other things being equal, which means ceteris paribus actually just means that, put it in your definition, you get a mark for that. Everything else stays the same. The law of supply says that if the price rises, then the quantity rises. Now why does that happen? It's linked to suppliers. Now if the price rises, people want to produce more and sell more because they make more money. So if price rises, quantity rises as well, increases. Then just as with demand, here's just a diagram with the price and the total quantity. I won't give you a table and expect you to draw a demand curve. I want to test your understanding just of the curve. Now, just from that previous table, you can draw this demand curve. If you work through it, you'll see all those values. You'll see on the curve, but you won't be expected to do it. But what I want you to understand is that the supply curve always runs like that. It's from the origin to the right-hand side. So don't get confused with the demand curve and a supply curve. This is the supply curve. And it's always that shape. I know you know it, but I want to stress it because I've seen in the assignment that students still get confused with that. So once again, if you draw a supply curve, it's the price on the y-axis and the quantity on the x-axis, and the supply curve runs like that. Then just like in the demand, you also get a table. Now, this is exactly the same as with demand. The only thing that causes a movement on the supply curve is again the price. So if you see a table like this, always just draw a line for yourself. Okay, sorry. So, I don't know what it did there, but distinguish between the first column, and then you'll see that a movement along the curve is caused by change in the price of a good. Same as with demand. But there are different factors that causes a shift. And this is suppliers, and demand was with consumers. So there are different factors that causes the supply curve to change, because it's got to do with the sellers and the producers and that side of the economy. So this is separate to all of this. Now, prices of alternative goods causes the demand curve to okay. So the prices of alternative goods, sorry, I'm just going to point with this, causes a decrease or an increase in total supply, where the price of the good causes a decrease or an increase in the quantity supplied. There's been questions on this previously, so you've got to know what the difference is between the quantity supplied and the total increase or decrease in supply, in all supply. And the increase or decrease in the quantity supplies happens when there's a movement along the curve, and that the movement along that curve is caused by a change in the price. So prices of alternative goods, you may be asked to list the factors that causes a shift in the demand curve. And take note of it. Here in the table, here are the factors. The prices of alternative goods, the prices of joint products, the prices of inputs, expected future prices again, technology, because the producers can produce more, and the number of firms. So these two tables with demand and supply is important. There could be a question on this. I said to supply and demand question counts the most in the exam, and these two tables could appear here. Maybe not the whole table, but a few. You've got to name a few, and you've got to name them right, because you're going to get marked on that. Okay. Once again, if you're asked to explain a movement on the supply curve or a shift of the supply curve, do them separately. It's much easier to understand. So there's a movement on the supply curve from, let's see if it works now, from point A to B. That's a movement on the supply curve. And once again, you'll see what causes that movement is a change in the price from P1 to P2. Clear, no? And if there's a change in the price and there's a movement on the curve, we said now that with supply, the producers will want to sell more. So that's why there's an increase in the quantity. If the price is higher with the supply curve, then the quantity also rises. Remember what I said that one. You understand that? Okay. And then a shift of the supply curve, you can do it either way, up or down. That creates a fall in supply. There's your original supply curve, and if it moves to the left, it's called a fall in supply. And if it moves to the right, it's an increase in supply. And here, that movement is called a movement in the quantity supplied. Remember? So the price, if I go back to the table, price of the good change, there's a movement along the curve, and that causes a change in the quantity supplied. Where with all the other factors, there's an increase or a decrease in supply itself. So if you study these two tables, I think you'll get a long way to understand supply and demand. Draw yourself a few curves and see. Okay. Let's carry on. Once again, that's just a combination of the two graphs, but I think it's better if you draw it separately. You'll understand it better. All right. And it also marks easier, because you show exactly what you mean. Then, everybody knows what equilibrium is by now? Yes. That's if you draw a demand and a supply curve on one diagram, where they cross, that's equilibrium. But you have to, sorry about that, you have to know the definition of equilibrium. Equilibrium is a condition in the market system when quantity demand is equal to quantity supplied. Now, that's a very important aspect of economics, because a free market system always works itself back to equilibrium. Okay? And important aspects of equilibrium, there's an equilibrium price at a particular price, and there's an equilibrium, okay, that price is called the equilibrium price, and then there's an equilibrium, I don't think I've put it on the slides, but obviously you get an equilibrium quantity as well, and that's called the equilibrium quantity. So let's go to a graph. Once again, okay, this table is fairly important. If you see, okay, this table in the exam could be a table asked. So you get the price. You don't have to work with the price. It's just an indication. But what you must work with are these two columns here. That's a quantity of tomatoes or any product demanded, and there's a quantity supplied. Now, as you know, equilibrium is where supply and demand is equal to each other. Now, if anywhere above this line, so if the quantity of the tomatoes is 360 and the quantity of tomatoes supplied is 0, then there's a excess demand of 360. Okay, so anywhere above that 0, there's an excess demand. And it's easy to calculate. This is what I'm trying to say. You may get numbers in the exam, and you've got to calculate. You may be given 320 and 50, and then you've got to say, is there excess in supply, and work it out, or demand. Now, yeah, you get 320 and 50, so the demand is bigger than the supply. So there's an excess demand of 270. Is that clear? And the same at the bottom. Sorry that but I just want to tell you what may be in the exam. Sorry, I just wanted to move down. Oops. Hey, sorry. Oh, there you go. So the same table, just remember where demand and supply is equal, there's equilibrium. And anything below equilibrium, if there's a demand of 160 but the supply is 250, then there's an excess supply of 90. So you just calculate what it is. It's easy. You just net off those two figures. So it's that 250 minus the 160 gives you the 90. And the same with the top. It's the 280 minus or the 100 minus the 280. That's why it's a negative figure. The negative figure always shows an excess demand, and the positive figure always shows an excess supply.
So you must always start with the quantity of supply the first one, minus the one.
Yeah. Yeah. Sorry?
Why you give 360 minus, why you give you negative?
It's because there's a bigger demand in the market. It's just, than supply. Then that means there's an excess demand of 360. Don't let the negative figure worry you too much. You must just be able to work out. Okay, don't worry too much about the negative figure. You must just be able to calculate that if demand is 360 and supply is 0, then there's a 360 excess demand. And if supply is 300 and demand is 320, then you net those two off, then there's an excess supply of 180. So just take note of this table slide. Is it 62?
So that means it took the 360 less 120.
Yeah. Just go through the calculation and you'll see. This could be a few marks for you, Marcelo, in the exam. Okay. Then what I Are you with us? Okay. So this is what I tried to say now. There's the demand curve and there's the supply curve. I think there was a question like this in the exam about excess in the assignment and excess demand. Now there's equilibrium. Now what's important to understand here is anywhere above this equilibrium, there's excess supply. Because the quantity demanded is smaller than the quantity supplied. That you can relate it back to that previous table, but you're not expected to do it. In the previous table, you must just work out the number and say if there's excess. But this shows you if quantity demanded is smaller than quantity supplies, there's an excess supply. And the same if quantity demanded is bigger than quantity supplies, then there's an excess demand. That table also shows you the same. Okay, so here's equilibrium, the original equilibrium. Now, if things change, either prices, and there's a movement on the curve or a shift of the curve, and the market goes out of equilibrium and causes an excess supply, the free market system has a way of correcting it back to equilibrium. And the price in the market will determine where's that equilibrium. That's why there's an equilibrium price and an equilibrium quantity. And the same with demand. If demand is bigger than supply and there's excess demand, the market works itself back towards equilibrium. The market won't stay over here for too long. It always corrects itself back to equilibrium. Happy with that? So important to know excess supply and excess demand. And in the table, you've got to calculate just how much excess demand or how much excess supply. Okay, study unit 5 is that application question in the assignment was about this, where you have to determine what happens with supply and demand and which has a bigger effect than the other, as you'll see from the assignment memo the answer sheet that we sent out. So this is what you had to illustrate in the assignment, is illustrate how a change in either demand or supply or the simultaneous changes between demand and supply will affect the equilibrium price and the equilibrium quantity. And then graphically illustrate the interaction between the markets. Now all this says is there could be similar changes. Flour could become scarce and they can produce less bread then. And how will the market, and what will happen to the market price and the market quantity? So if you get a practical question, follow these steps. This is slide 66, and these are the steps. Steps 1, step 2, and step 3. You must determine whether the demand or supply curve will shift the movement along the supply curve. That's so important. It's so important to understand the movement on the curve and a shift of the whole curve. Step 2 is determining which direction this curve will shift. Say, for instance, if we go back to, I want to quickly go back to that table of supply. Let's just work with supply quickly. So, if let's work with technology. If there's a cost reducing, cost less to manufacture, then the supply curve will shift to the right. There will be an increase in supply. Because the cost to produce it is less, the producer can manufacture more. So you've got to determine which direction it will change. And the slides that I've just shown you here, the steps. So first step is determine whether it's demand or supply, which one will shift, and if there's a movement along the curve. And maybe they can both shift, and it can be a movement. Normally there's a movement along only one of them, and the other one will shift. So in a practical application, just see if both supply and demand shift, or if there's a movement on the one curve, and a shift of the other curve. Don't let it baffle you too much. In the assignment, we've tested you on this more. So in the exam, it will be a little bit more straightforward, to tell you the truth. Okay. So, but follow these steps. Step 2, determine which direction it will shift, or which direction the movement will be. And step 3, show the change in the equilibrium price and the equilibrium quantity. So I'm getting back to the definitions on this slide. Definitions count quite a bit, so these could also be definitions. Normal goods and inferior goods. You just got to know what they are. So if there's an increase in income, normal goods, for normal goods, then the demand increases and the demand curve moves upward to the right. So if you get an increase, you're going to spend more on normal goods, so the demand will increase, and then the curve will move upwards. You can just go through this, and it will make sense to you. So increase in income and a decrease in income, and what the effect will be on normal goods and on inferior goods. Now, just to explain to you briefly the difference between a normal good and an inferior good. An inferior good has got a negative income elasticity, but as an example of an inferior good, what I always use is a hamburger. And a normal good or a durable good is steak. So if your income increases, you'll spend more on the normal good, which is steak. You'll buy more steak, but you'll buy less hamburgers because you can afford it. So inferior good is always the opposite way. So if your income increases, the inferior good, the demand decreases normally. So that's what just as a practical explanation. And then a decrease in income is just the other way around. So just understand what the increase and the decrease in income will cause between normal goods and inferior goods. And that's why you just got to know what is a normal good and what is an inferior good. Use the example of a hamburger and steak.
How about chicken and lamb?
Chicken and?
Chicken and lamb.
Lamb?
Now it's for chicken
Yeah.
and then lamb before
Okay,
it's
to answer you, she asked, what if it's chicken and lamb? Lamb is 120 Rand a kilo. Chicken is, you get for 39 Rand a kilo. So if your income increases and you like lamb, you're going to buy more lamb and less chicken. So understand that. Because chicken could be inferior, it's nice in that, but it could be, in economic terms, inferior to lamb because of the price and because of taste. Okay? So there's demand and supply in action. There was a question like this in the assignment. Not exactly this, but this is where the demand curve shifts to the right, and because of the price that increased, there's a movement along the supply curve. Supply didn't change, but demand changed. And there's vice versa. Here demand changed and supply stayed the same, but there's a decrease in price. Increase in price, decrease in price. So then what's important to note is, here's your, that's why equilibrium is so important. Here's your original equilibrium, your original demand curve and your original supply curve. Then the demand curve shifts to the right, to D1. So there's an increase in demand. So obviously the equilibrium is going to change. You're going to get a new equilibrium price and a new equilibrium quantity. So it's just important to note that if supply stays the same and there's an increase in demand and the demand curve shifts to the right, now that shift in the demand curve will cause a movement on the supply curve because of the price that, remember we said price is the only thing that changes the curve, that causes a movement on the curve. So that price change causes a movement on the supply curve. And that gives you a new equilibrium point with a new equilibrium price and a new equilibrium quantity. So that's the concept that you've just got to understand. So in the exam, I didn't make it too difficult. It's just the concepts that you've got to understand, like this one. You won't be expected to draw complicated supply and demand curves. You just got to illustrate more what you understand. Okay. Then, I'm not going to go through this in detail. This you can read. This is related to the previous slide. It's just when it moves to the right and when it moves to the left, when there's a decrease in demand or an increase in demand. That comes back to those tables that I gave earlier. You'll see if you go back to the table, then you'll see why this happens. Now, more changes in demand can be between substitute and complement prices. substitute price is if you substitute one product with another product, then the demand curve increases and shifts. If there's an increase in the substitute price, then the demand curve will shift upwards because the demand for the normal product, if the substitute gets more expensive, people are going to rather go for the normal product and vice versa. And increase in the price of a complement, that normally complement products, the demand changes the same. If the price of one goes up, the demand of both will go up because it's a complement. But if it's a substitute, the principle is that you'll buy more of the substitute if the price of the normal good go up, and vice versa. There's a decrease in the substitute and a decrease in the complement. Now, this substitute and complements were in that table, showing you that it will cause the demand curve to shift. Remember that table, that bottom part was a whole lot of them. Now, go and look at the table. Substitute and complements are in there. All you have to know is that table. The table says exactly what you see here. So if you know the table and you understand it, you'll. So in the exam, once again, I just want to say, expect that you may be asked what causes either the supply or the demand curve to shift, and what will cause a movement on the curve, and what it will look like graphically. Then you must show what will happen, that the movement on the curve is that from A to B, and the price and the quantity changes, and if there's a shift of the curve, the price stays the same, but the quantity changes. Okay? So that's the most important part for the exam, I think. You can go through this as well. This is also in that table. This is just a summary of what can cause an increase in supply. Remember, an increase in supply is when the whole curve shifts. That's called an increase in supply. So what will cause the demand curve to shift or an increase in supply? All these will cause it's a supply side. So if you know the tables, then you'll know this. It's the same. And this is once again where we had that the demand curve shifted, but the supply curve stayed the same. Yes, just the demand curve stays the same, but the supply curve changes. Now, if you get a practical question, go back to those steps and just see if it's the demand curve that's going to shift or if it's the supply curve. Go back to those steps and you'll make it out for yourself. So if, say for instance, there's a farmers, they breed cattle and there's some sickness amongst the cattle, then what do you expect is going to happen? Cattle are going to die, so the supply will decrease. So the supply curve will shift like that. Okay, and what will happen with demand? Demand won't change, but because there's less cattle now, the price in the market is going to be higher. So there will be a movement on the demand curve when that happens. Just as a practical explanation for you. All right, the same, exactly the same. This is in the tables. One is about supply, and this is more changes in demand. The previous ones were in supply. So just go and read those two tables and study it, the demand table and the supply table. And if you go through it, you've still got lots of time. You must ask, you must come and ask. I mean, not now. If you work through it going forward, you only write what the end of October, 31 October, or was it 1 November? 1st of November. So we've still got time. If you don't understand, rather ask. No question will be ignored. And if it benefits everybody, I'll put it on the group. Maybe it will help other students that's too ashamed or too shy to ask, you know, what I'm saying to you. Okay, so there is all about the supply. So in that table is this as well. What will cause supply to change. It's in that table. So if you study the table, I think you'll know it all. This is just basically a summary. See there, for instance, if there's an increase in productivity for some reason, then the supply curve will shift downwards, means to the right. So if there's an increase in productivity, they'll produce more. That's why the curve will shift to the right. And the quantity will be more. But remember, let's just stick to this one. So the supply, here's the demand and supply curve. Price and quantity, there's demand and there's supply. So with this one, the supply curve will shift downwards or to the right. So if you've got to illustrate what's going to happen, this was your original equilibrium. What's going to happen here? If the supply curve shifts to the right, the quantity is going to change to the right. So the quantity will increase. But because it's just the supply curve that shifts to the right, the price in this instance, I didn't actually need to draw the demand curve. Because we're basically just on supply. Let me not confuse you. Let's try another pen. Okay, so that's price, quantity, that's your 0 point. Let's just draw the supply curve. This is what this is about. So here's your supply curve 1, and there's your supply curve 2. Now if this happens, the supply curve will shift downwards. So what I want you to know, remember we said price, if you have to illustrate it, the price stays the same, but the quantity will change from Q to Q1. So you've just got to understand that concept. And the same with demand. Okay. Everybody still awake? All right, so this just shows you various options. So for instance, there's an increase in the price of the factors of production, a decrease in the price of the factor of production, but that is in the table as well, you know. So if you go through your table, we're working with supply. Go to the supply table and see what will cause a shift in the curve. There's a shift in the curve. And then you'll find this in that table, factors of production, productivity or whatever. You'll find it in the table. So I'm giving you good tips here tonight. Study those tables and make sure you understand it and just draw the diagrams for yourself, a shift in the curve and a movement on the curve. All right, this is just a summary that if there's a change in demand, just go through this table. Don't worry about this too much. This won't be in the exam. Don't want to confuse you. Rather concentrate on what I've said about supply and demand. Here's simultaneous changes in supply and demand. That was a question in the assignment. Both the curves shifted, the supply and the demand curve. Now this is just an explanation of that. So if you, let's see the next slide. No, so you must determine if the shift is the same. But if the supply is going to be affected more, which was the case in the assignment, then the shift in the supply was a lot bigger than the shift in the demand, if you look through your answer sheet. And that causes different movements for equilibrium and the prices. So take that question, that assignment question, that practical question, and just go through the answer sheet and see how the curves have changed. Then this will make sense to you. So I don't want to go on it too much. What I want you to know on the supply and demand is that tables, you've got to know what a movement is, that it's a change in the quantity demanded or supplied on the supply side, and then what causes a shift of the curve, and that's called a shift or a change in the overall supply. Know the differences between that? You must be able to show that graphically, your understanding of that. Then minimum prices, maximum prices and minimum prices, subsidies and taxes, that's all government intervention in a perfect competitive goods market. So remember, a free market, the demand and supply determines the price, the market system. But government can intervene. That's why we've said we've got a mixed system in South Africa. They can intervene. And if you ask, how can the government intervene in a perfectly competitive goods market? They can use maximum prices or minimum prices or subsidies on certain, or taxes on certain products. And then if you want to know the understanding of those maximum prices, it's mainly a price ceiling. So the government won't allow producers to ask more, than a certain price. And it can be price control or administered prices. And minimum prices is price support. If they want a minimum price, then they support that price there. I think there was a question in the assignment. The government purchased certain amounts in the market to keep the market at a certain price, or a minimum or a maximum price, or sell in the market. And that's called a minimum is a price floor or a price support. Just know that over there. Then examples of government intervention, we focusing here, let's look at the maximum price. So what's important here is there is a normal demand and supply curve diagram. But a maximum price is where the government don't want the price to be too high. So the normal market price and equilibrium is there by P0. So they normally set a maximum price below the normal market price, maximum price, because they don't want it to be more than that level. And then there's a distortion in the market, and that causes excess supply and demand as well. But what's important here that you must know is that government can intervene, and if they introduce a maximum price, it's normally below the market price. And the opposite with a minimum price. A minimum price is normally set above. This is a practical example. Minimum price is, say for instance, 15 is your normal market price, but they want the price at 20. Remember, that goes back to that surplus. There is a surplus supply. It causes a surplus supply. You go back to that surplus supply and the surplus demand at the bottom. But in this case, if I introduce a minimum price, so if I introduce a minimum price, that means they want the price at a certain level and the market price is too low for them. So they normally set it above the market price, and that causes a surplus in the supply. Then examples of government intervention, those previous examples, they can also use, that's a typing it as subsidies, taxes, quotas, and import tariffs. Now, as it says there, you can just go and read through it yourself. Taxes is quite easy to understand. Subsidy is where the government subsidizes certain producers to produce something. And quotas is where they put in a quota. The supplier cannot produce more than a certain amount. And that's how they affect the market. And the same with import tariffs. If they don't want to import too much from overseas, then they introduce an import tariff. So they want to stimulate the local economy by by putting import tariffs, preventing companies to import from overseas because they must produce it locally. So that's the way they can affect the market. All right, I think supply and demand in the exam, I'll get to it now in my notes that I've made for you, but it counts the most marks in the exam. It counts 24 marks in the exam. So everything I've said here, take it in. There could be one small application question, but focus more on the basic principles of the movement on the curve, the shift of the curve. 24 marks, all right. Now, study unit 6, also always an important study unit for the exam. And it's all about elasticity. These are the important things that you got to understand. Elasticity in the exam, I think, counts 14 marks. I'll tell you later. Let's just wait for her. I think it's important for her to be here. Okay. So we're talking about elasticity now. We've just started. See? So this is the important things that you've got to define elasticity. You've got to discuss price elasticity of demand. You've got to indicate the relationship between elasticity and total revenue and discuss factors that may influence price elasticity of demand. I think this was asked in the assignment. You've got to give a definition of price elasticity. And what's important again is to show that it's is the percentage change in the quantity demanded if the price of the product changes by 1% and everything else stays the same, or ceteris paribus. That's the full definition for 2 or 3 marks that you've always got to give. And then the formula to calculate elasticity is the percentage change in the quantity demanded over the percentage change in the price of the product. Now the formula looks like this. That delta sign, that triangle you see there, stands for a change in quantity over the quantity. That gives you the percentage change in quantity. And the percentage change in price over price gives you the percentage change in price. Everybody understand that, eh? Okay, so you will always get values. So what happens here is a numerical example to calculate point elasticity. Now, point elasticity in this case, coincidentally, is 1. And the way you calculate it is there's a price change from, price drops from 12 Rand to 8 Rand. That's 4 Rand. That's where that 4 comes from on the price side. Remember, if you go to the previous formula, the price is at the bottom. So that's where the price change comes from. That 4 comes from that drop over there. And the drop came from 12 to 8. So the original price was 12. So that's why it's 4 over 12. To give you the change in the percentage change in price. And the same with, sorry, I don't know what that is. Yeah, the 6. So on the quantity side, because the price dropped, the demand for the increases and the quantity increases from 18 to 24. And that's where that 6 comes from, is the difference between those two. But the original quantity was 18. That's why you use 18 to calculate the change. So if the price rose, it will be the other way around. 8 is the basis price, and if the quantity then is the other way, you'll use 24 as the basis price. But it's the principle. So just work through this, and coincidentally, this gives you 1. But normally, the price, it will be normally 1 plus. So it will be 1 or 1.5 or 3.5. It won't very seldom be less than 1. So it's just because the ratios are exactly the same in this instance. The formula works out that it's 1. So do that calculation and see if you can get that. So if those values have changed, then that value will also change. That's what I'm trying to say. It's just an illustration. Then people battle to understand the difference between arc elasticity and point elasticity. Point elasticity, all that it's saying is, if you look at the demand curve, point elasticity means it's a specific point on the demand curve, where arc elasticity, they also say it's midpoint elasticity, will work on 2 points on the demand curve. So point elasticity is just 1 point on the demand curve. Arc elasticity is over a price range, normally between 2 points on the demand curve. I just want to get to if you ask what is arc elasticity, define it, then all you have to say is price elasticity of demand in a price range or between 2 prices will also work. Then the formula to calculate arc elasticity is very much the same as elasticity. There's your change in quantity, but then you work with both the quantities, not just the one. Remember, it was in point elasticity, it was a change in quantity over the quantity. But here you add the two quantities that you get. If you go back to that graph, you're going to add 12, the quantity, you're going to add 18 to 24. And then in the middle of those two is the midpoint elasticity or the arc elasticity. So that formula, all it does is it gives you the midpoint on the quantity side between that, but also on the price side between those two. So if you look at that formula again, it's quantity 1 plus quantity 2 and price 1 plus price 2. If you go to the values, you'll see that it's the 18 plus the 24, and that gives you the 42. That gives you the midpoint of those two. The formula works it out that it's the midpoint between those two. And the same then for the quantity on the price side and the quantity side. So if you work out that formula, you'll see that the arc elasticity is normally smaller than the point elasticity. It's because you work with 2 points, where with point elasticity you just work with the 1 point. So it's important that you, from a graph like this, can calculate values. It could be different values now in the exam, but if you do it this way and you understand it, then you just apply that formula. Study the formula, know what it is, and apply it. That's all you have to do. All right, then what's further important is you have to know the different elasticity values. Now that is called a coefficient value, elasticity value. EP stands for elasticity, and that's the coefficient for elasticity. So I'm going to start with elastic. Let's start with elastic. The elasticity value for elastic is normally larger than 1. That's why I said no. Point elasticity is normally a value bigger than 1. But if a product is said to be elastic, that means, if you think of a band, a rubber band, if the price changes, if it's elastic, the quantity is going to, either if it comes down, the quantity will change more than the price. That's what elastic means. That's why it's bigger than 1. So if the price rises, then the people are going to demand a lot less, more than what the price change was. We'll see it on the graphs now. And inelastic, I'm going to stick to elastic first, and inelastic is just the opposite way. So if the price changes, if a product is inelastic, then it won't stretch at all. It's not really going to matter what happens to price. People are still going to buy it, like bread. Bread goes from 14 to 16 rand, people will still buy bread. They won't buy particularly less bread. So then a product is said to be inelastic. So if a product is elastic, if the price changes, the quantity will change more. And if it's inelastic, if the price changes, the quantity will change not at all or less. That's why it's between 0 and 1. And if it's perfectly, we're staying now with inelastic, perfectly inelastic, that means the value is 0, so there will be no price change. So if price changes, there will be no change in the quantity demanded. Avis girls, are you with us here? Yeah, okay. And then perfectly elastic means that if the price changes, the market can react in such a way that they'll almost demand nothing of that product because the price changes. Then it's perfectly elastic. And that can be into infinity. That's a sign for perfectly elastic demand. It's infinity. And if you look at the graphs, I'm going to not stick on this graph. I'm going to go to the summary of the graphs. Can everybody see these graphs? Okay. So let's stick with elasticity first. I started now with elasticity. Now here's elastic demand. This graph here, sorry, this one is elastic demand. Okay, there you go. So this one is elastic demand. Now what's important, you take note of it. In the exam, you may be asked to draw some of these graphs. And what's important, what you must show. If it's elastic, this is the graph for elastic. Once again, you draw the demand curve. But if it's elastic, draw the demand curve with a slope flat. So that if there's a 10%, remember we said if the price changes by 10%, then the demand will change more. Remember? Then it's elastic. So then the demand will change by 15%. So if you're asked to illustrate elastic demand with a graph, then you've always got to show the percentages it will change more, quantity will change more, and you must always give the coefficient value of the elasticity. So you'll get marks for that. You may be asked to draw 2 or 3 of these, or maybe all of them. So practice these graphs. So elastic.
Gives us two.
Okay, it's not all of them, but okay. But what I want to stress is you must make sure which one is which one. This is elastic now. Yes, inelastic. So sure. I don't know why that happened. Let's take another pen. So yes, inelastic. So elastic and inelastic. Now inelastic is where if there's a price, you draw the demand curve, but draw the slope, for inelastic, draw the slope steeper. Because then you can easily demonstrate that if there's a 10% change in the price, there'll only be a 2% change in the quantity. So then, remember, then it doesn't stay so much. So if there's a big change in the price of 10%, it will only cause a 2% change in quantity demanded. Okay. Now, from that you can move to the rest. You can go to perfectly inelastic. Now, the way the perfectly inelastic curve is a vertical curve like that. That means there can be a change in the price of 10%, and there will be no change in demand at all. That's perfectly inelastic. And perfectly elastic is a horizontal curve. So if nothing will change. If the price changes, people will, up to infinity, the value is that infinity sign. Does everybody know the infinity sign? That's the infinity sign for perfectly elastic. So EP for infinity elastic is EP for perfectly elastic demand is the infinity sign. That is that little sign there. You'll see it in the presentation. So what it means, if the price if the price changes just a little bit, people will buy nothing of that product. It can fall to 0 or to infinity. So, and then unit elastic is the easiest of them all. Unit elastic is there's a 10% change in the price, there will be a 10% change in quantity. It's exactly the same ratio. So you can also draw it with a linear curve, but it's better to draw unit elastic with a curve. You won't be penalized if you draw a straight line. If you draw a curve, price and quantity just like this, and you indicate 10%, and that's also 10%, you will also be right. Unit elastic just means the change in the price and the change in the quantity will be exactly the same. So take note, this may be in the exam. Okay, then I just wanted to demonstrate, so study those graphs, put in the percentage changes, put in the elasticity values, the coefficients for marks. Okay, could count a few marks, there. I'm just going to stick to this graph here. Remember I said to you a linear demand curve. You may be asked to explain elasticity on a linear demand curve. Now a linear demand curve is with that should, it doesn't show there, it should be price and quantity there. And a linear demand curve runs and touches the axis like that. And then if a product is elastic, unit elastic, it's in the middle of the curve, then it's unit elastic. The price changes in price, or the change in price and quantity exactly the same. Anywhere above unit elastic, in the middle of the curve, anywhere there, it becomes elastic. And remember, it's bigger than 1. The sign is, the elasticity value is bigger than 1. And up to infinity over there. Up to perfectly elastic. And anywhere below the middle of the curve. In a linear demand curve, from the middle, the top part is always elastic, and the bottom part is less elastic. Up to perfectly inelastic. That's what you've got to demonstrate. I think in the sign, I can't remember, I think there was a question. So you had to show elastic, and you had to show perfectly elastic and inelastic and perfectly inelastic. So just be sure that you can do that. Do you want to see that previous slide? It's exactly the same. That tells you exactly the same as that. So I'm not going to even stand. That is just a illustration. That's for information only. So that explains the previous curve, but you won't be given this table and expected to fill it in. Rather demonstrate with the graphs. Okay. Now, I'll just quickly, elasticity has an effect on revenue. So you just got to know the relationship between elasticity and revenue. So this is a typical revenue curve. Starts at 0, revenue goes up, and when people now, so that you can see for yourself, that will be inelastic. We'll get to it now, and that will be elastic. So if price rises, you'll see what happens now. This is just the shape of a total revenue curve. But if you relate it back to that curve I showed you now with unit elasticity there, and elasticity and perfectly, and you complete the revenue curve, where it's unit elastic, it's at its best, because if the price changes, your revenue won't change. But if it becomes elastic, if the price changes, it causes a bigger change in quantity, then your revenue is less. That's all this shows you. And if on the right-hand side here, if you become inelastic, so the price changes, but there's not such a big change in the quantity, then it starts coming down on that side, the total revenue as well. There will be a change, but only up to a point. So all you've got to, if you ask to show the relationship between a linear demand curve and elasticities on that demand curve and the total revenue curve, then this is the demonstration that you'll give. In previous assignments, we've asked values and all that. In this exam, we're not going to give you values in that. Just recognize the revenue curve and how it changes when a elasticity change on the demand curve. But I would say rather focus on definitions of elasticity values, and drawing those graphs, showing the different types of elasticity. I wouldn't worry too much about this. This is for your information. That's why I said I'd give you some tips. So I didn't ask this in the exam. Now, this is things you just got to know about elasticity. You just got to, the factors influencing elasticity of demand are the factors. So we're not going to ask you to explain or give values or nothing. You must just know the factors that has an influence on the elasticity of demand, and those are the factors. So it's slide, is it 99? Yeah, slide 99 is important. You may be asked to list the factors that influence the elasticity of demand. And it won't be explanation, it will be just a listing of those factors. And then together with that, it's just actually a continuation, is the definition of the product, advertising, and the number of the uses of the product. You may be asked to list 5, and you can list any of those, for instance. Then that's why I said earlier that it's important to establish whether a product is inferior or a normal good. Now, inferior products, you remember I said hamburgers, it has a negative income elasticity. Remember, we're talking about income elasticity. I just want to stress that you have to know what's income elasticity. I think it was also a question. Income elasticity is if your income increases or decreases, what's going to happen to the quantity that you're going to buy? So it's not the price, but it's the income. So if you get an increase, you're going to buy more because you can afford it. Okay, so that's all that income elasticity is. And what's important for income elasticity, you must distinguish between an inferior and a normal good. So inferior product, this may be in the short questions, that's why earlier on I mentioned it. Inferior product has a negative income elasticity. You may be asked in true or false, given a statement saying inferior products has a positive income elasticity, then you must say it's false. You must know that it's got a negative income elasticity. And the same for normal products. That is not so important. Just know that inferior products has a negative income elasticity and normal products has a positive income elasticity. And then there is a question about cross elasticity. So this slide 102, just take note of it. You've got to know what cross elasticity is. And what's important with cross elasticity, that means if the price of one product changes, it's going to have effect on the price of another, and the quantities demanded of another product. And what's important here is you've got to establish whether it's a complementary good or a substitute good. Now, you've got to know, for the short questions, I can recall it, you've got to know what complementary goods is and what is their elasticity attributes. It's got a negative income elasticity, and they show it like that. And substitutes has a positive cross elasticity, and that's the elasticity value. It's bigger than 0 and smaller than 0. So this slide 162, just make sure that you study that. Okay, elasticity, cross elasticity, we did say it measures the responsiveness of the quantity demanded of a particular good to changes in the price of another good. So that's all cross elasticity means. And then you've got to see that if it's an inferior or a substitute product. Remember that. Sorry, not inferior, a substitute or a complement. And then elasticity of the supply, all you need to know here is the definition. It measures the responsiveness of the quantity demanded of a particular good to the changes in the price of that related good. So just know what cross elasticity is and what elasticity of supply. So you get point elasticity of demand, then you get arc elasticity of demand, you get cross elasticity of demand, income elasticity of demand, and supply elasticity. Those 5, you just got to know the differences, but focus more on the demand elasticity. This will just be in short questions that you got to recognize certain things. All right. Elasticity, people normally throw up their hands if they talk about elasticity. It's not so difficult. Look at that video clips that I sent you again, and then you'll see that it's not as bad. And I'll send more in time coming before the exam. I'll send more an explanation on these. And if you battle to understand, then obviously please contact me. All right, then study unit 7. I just want to see something. I think there's a few questions on this in the exam. Yes, okay, it counts 10 marks in the exam. 10 marks. Sorry? No, this is easy. Okay, so once again what's important is you've just got to explain in difference curves. The definition of a budget line and examine the effects of a change in income and price. Not to confuse, remember the PPC, the production possibility curve in study unit 1. The curve ran concave like that, remember? PPC curve. And you had to explain a point inside and a point outside and a point on the curve, remember? And it was good A and good B. Now in difference curves, is the same as this. The only difference is that the curve runs convex. So it's also product A, product B, and this is the indifference curve is normally given by the sign of a U. So you must just know what this say. Explain what indifference curves are, find the budget line and explain consumer equilibrium. While we're on this point, consumer equilibrium on an indifference curve is always where, if your budget line runs like that, we'll get to the budget line. But equilibrium, consumer equilibrium is where those two touches. That's the point of equilibrium. We'll get to that in a minute. Okay, and then effects of change in income and prices. That's quite easy to understand. This wasn't asked. So just read through this. But you've got to know the definition. It shows all the combinations of two products that will provide the consumer with equal levels of satisfaction. Obviously, this is just for consumers, where the PPC curve was for producers. So this is just for consumers. So that's the definition. So once again, the graphic illustration, the numbers not going to be asked. What I want you to know here is, I've already said it to you, this is the shape of the curve with bread there and meat there. It could have been blankets and pillows. Remember, you can use any two products. This is just an illustration. So I normally, if you say product A is fine or product B, but in the exam you may be given a question with two products, and it will state, put that product on the x-axis and that product on the y-axis, and then draw a budget line with certain values. Now I'll get to that in a minute. And then you may be asked to show consumer equilibrium on that graph, and then you draw an indifference curve that touches that budget line in the middle, the best touch, where it's we could say where it's tangent to the budget line. That's consumer equilibrium, but I'll show you now. So indifference curves, we already said it's convex, it slopes from left to right, they never intersect, and the indifference map is just a, this is, I just want to show you the indifference map. There's an indifference curve map. They never intersect, but they run parallel like that. So it's U1, U2, U3. So I'll get to this. All right, that's the indifference curve map. We've said it. Then the law of substitution is available. Now this is easy. The curve becomes flatter as we move towards the right of the curve. So if you think of the curve, it becomes flatter. And now it runs like that, and then it becomes flatter. So this may be a short question. What is the shape? What happens to the indifference curve if we move from right to left on the curve? It becomes flatter. And the scarcer the good becomes, the greater the substitution will be between the two. That is not asked, but it explains what the theory of indifference curve means. Then this definition you can study, slide 111, marginal rate of substitution. The definition is that it's the rate at a certain point at which the consumer is prepared to sacrifice a small quantity of one good for a little more of another good. I think that was also in the assignment. So that is important, this definition. And the formula of the marginal rate of substitution is the quantity on the y-axis and the quantity on the x-axis. That just gives you the slope actually of the indifference curve. But it's more, what I want to know more is the definition. And then also the definition, so firstly it's the marginal rate of substitution, and the next one, you're going to get this, is law of diminishing rate of substitution, or the marginal rate of, law of diminishing marginal rate of substitution, the MRS normally. And the definition, MRS, yeah, the same, there's the definition. But the law of it is when moving from left to right along the indifference curve, the marginal rate of substitution decreases. So just be able to recognize this statement over here. And if you're not sure, you can email me and I'll explain it to you. Now there's the indifference curve map. So for exam purposes, you don't have to know that. But this is important for exam purposes. You're going to be asked maybe to draw indifference map, but draw the budget line. Now there's the budget line there. That is a budget line. So you will be asked to put quantity of bread on the y-axis and quantity of meat on the x-axis. Maybe not those products, but other products. It could be any product. But you'll be told which product to put on what axis. And you'll be given a value. You'll be given a... What you'll be given here is, for instance, on this graph, that is the quantity of bread. You can buy 6 loaves of bread, and you can only buy 4 portions of meat, because meat is more expensive than bread. So your budget line, you'll be given those values, the 6 and the 4. It could be other values, but you must be able to draw the budget line with values given on the y-axis and on the x-axis. So what that says to you is you'll be given a budget. Your total income is your budget, 24 Rand that you have in your pocket. How many bread can you buy and how many how much meat can you buy? So bread is cheaper than meat. That's why it's only 4 Rand and meat is 6 Rand. Now, that you can, from your total budget that you get, you can divide your total budget by the amount of bread, which is 6. And that will give you, it's 4 Rand, but you can buy 6 loaves. Do you understand that part of it? Okay. And the same with meat. You can only buy 4 portions of meat. So divide that 4 into your total budget, then you can buy, the price of meat is then 6 Rand. So you can, if you're given the values, you can determine the price. If you're given an income, a budget, which you will be given, you can determine how much of each you can buy and what the price will be. Okay. So just make sure you can draw this graph with a budget line, with a product on that axis and on the y-axis, and you'll be given 2 values. So just you can name any value. Say that's 12, then you make it 2, 4, 6, 8, 10, 12. And that's where it crosses. Use that value. That's your total budget will be that price. And the same here, if it's, say for instance, 8, you'll be given 2, 4, 6, 8. So, but use this as to practice it. So the slope of a budget line. I think there's a question about this in the exam. The slope of the budget line is nothing else than the marginal rate of substitution, but let's stick to the slope. The slope of the budget line is calculated by taking the price divided by the other price. The price on the x-axis divided by the price on the y-axis. Sorry, the price on the x-axis, I'm right. So there's 4 portions of meat, but remember the price of meat was 6 Rand. So it's the price of meat divided by the price of bread. So it's only always the price on the x-axis divided by the price on the y-axis. But if you haven't got the prices and you've only got the values, you can also do it the other way around. You can divide the quantity by the other quantity. Quantity on the y-axis is just the other way around. Remember the price was the x-axis first, and then on the y-axis. Now if you have the quantity, you can take that one first. 6 divided by 4 also give you 1.5. Okay. So you can calculate the slope 2 ways. If you're given prices, you take the price on the x-axis and divide it by the price on the y-axis. If you're not given prices but quantities, then you take the quantity on the y-axis divided by the quantity on the x-axis. So that is self-explanatory. The quantity of meat on the x-axis is 24 divided by 6 gives you that 4 quantity. And the same for bread, 24 divided by the 4 Rand that we've got there gives you the 6 loaves. But for exam purposes, you're given the quantities and you're given a budget and you're asked to draw a budget line. Okay? And then another part of the question is they ask you where's consumer equilibrium. Now, I said no, that consumer equilibrium is where your budget line is, then you draw an indifference curve that touches that budget line. And the point B is the consumer equilibrium always. And remember, this is an indifference curve map. You may be asked to draw an indifference curve map, and you draw that, and then you're asked to draw one budget line according to the values, and then you draw one, and then you've got to say where consumer equilibrium is. Okay, this you don't have to worry about. Just know that point B is consumer equilibrium. Consumer equilibrium changes due to change in the income or change in the price. So if you go back to that slide, if there's a change in income, same as with the PPC, if there's a change in income, the budget line shifts parallel, then if there's a change in income, either up or down, say you've got more income, then your budget line will change parallel. So your indifference curve will also change parallel. Remember, they never intersect. So if there's an increase in income, you're going to get a new budget line which lays above the old budget line. So that's all that says. Change in income causes the budget line to shift parallel. But if there's a change in price of only one of the two products, then you get that swivel effect again. I didn't say it here, but if you go back to this graph, remember the price for bread was R4, remember from the slides, but the quantity was 6. So say the price of loaves of bread here stays fixed, and the price of meat goes from 4 to 5 rand, it rises, then it's going to swivel. But if both the prices change in the same format, then obviously you'll get a parallel move. But if the price of one is kept constant and one increase, then what we call a swivel of the curve. But the swiveling part is more asked in the PPC, not particularly in the indifference curve, but it's the same principle. Remember, the PPC was just for producers, and the indifference curve is for consumers. Okay. The rest I'm going to go through a bit quicker. That is not so important. We've said that. The change in income always shifts the indifference curve parallel. That may be a short question. So what causes the budget line to shift parallel? Is it a change in price or a change in this or a change in income? You must be able to recognize that the income. Change in price of either one causes if one constant and the other one changes, it's a swivel. And if both changes, it moves parallel as to the right as well. Then I think this question was in the assignment. You get two budget lines with two indifference curves. Remember, the indifference curves always touch the budget line at the best point of tangency there. And then if you draw that through the curve of the line right through, that's where the income consumption curve comes in. So just go and revisit your assignment, that question, and that will answer that part of it. Okay, there's an effect of increase in price. That's what I said. No, that's a swivel. The price of one fixed and the price of the other one changes, then that is a swivel. Now, where the previous one was the income consumption curve, if you've got to illustrate the price consumption curve, then you'll draw the swivel, because the price consumption curve is also through the points, but because there was a swivel, your points changes. So your price consumption curve runs parallel. So if the other question was in the assignment, this question could be in the exam to show the price consumption curve. And then you can just relate the demand curve back to that. But it's more a practical question to show equilibrium, consumer equilibrium, to show take a budget line and then draw an indifference curve map and show how it changes from there. And you're going to be given a budget. You've got to work out the price and the quantities and explain what that means. And then work out the slope of the budget line. Remember, we said the slope is either it's the price on the x-axis divided by the price on the y-axis. Or it's the quantity on the y-axis divided by the quantity on the x-axis. So you're going to be asked to calculate the slope. So go back to that formula. This particular, just know that you may be given a graph and asked what is that curve there. You must know that that is the price consumption curve. Same as you must know that that is the income consumption curve. Okay. All right. This is I know it's a lot, but I want to go through the bit of more of a summary on the exam questions. So I'm going to rush through the rest quickly. The only thing that I'm going to concentrate on are the tables, just to make sure you understand the table. Okay, students, this is what you must be able to do. You must be able to difference between the short and the long run. It could be short questions. You've got to define certain revenue, cost, and profit concepts. All of these, just make sure that you know them. Profit is simply that, and revenue is simply that. Total value of sales, revenue is total value of sales. Poof, that's it. So it's the quantity times the price. That gives you your revenue. And profit is the surplus of revenue over cost. That's straightforward. Now, these are the tables that students battle with sometimes. And this is not difficult. This is revenue, see here. In the same, it could also have been cost. Or it could have been product. So that revenue could have been cost or it could have been product. The principle stays the same. So you'll always get a quantity or units. Units. So this is an important column. And then you'll be given in this, if you want to calculate revenue, there will be a price. But if it was cost, you'll be given maybe an average, so not an average, a fixed cost and a variable cost. We'll get to a table now quickly. I just want to show you that the average calculation is quite easy. Is you just take the total revenue. In this case, you've got, remember we said revenue is quantity times price will give you the total revenue. So if you work with any average, and you must work out the average total revenue or the average revenue, and you take that total revenue and you divide it by the units. So that's always Q. So you take, here's null, that's why the average revenue will be null. But here total revenue is 400, divided by 100 will give you the 4. So average is always just whatever you work with divided by the quantity. It's always average, it's easy, it gives you the average. The one that students battle with is the concept of marginal cost, revenue or product. And it's not difficult. Look on the slide and memorize this formula. The marginal is always just the change in the total, either total revenue or total cost or total product, divided by the change in the quantity. Now, let's go to these two lines here. If you want to work out the marginal revenue over here, line 2, is you take the change in total revenue, which is from 0 to 400, which is 400, and you take the change in the quantities from 0 to 100, that's 100. So it's 400 divided by 100 is 4. And the next column will be the change from 400 to 800 is again 400, and the change from 100 to 200 is also 100, and that's why you also get 4. But if this was to 300, say for instance, then it would be the 800 minus the 400 is 400 divided by 200. You see what I mean? So you just got to work with it, the difference between those two every time, and the difference between those every time. Then so go and practice this table and see if you can do it. And the same principle is for cost and product. We'll quickly go through the tables there. But the principle stays exactly the same. I don't have to wipe it out, I think. Sorry? You'll be given a table with certain values, and you've got to calculate the values. That's why you must know the formulas there at the top. Those formulas. Yeah, you must know. No, you must know them. Yeah. Yeah. So what she's asking is, in the exam, they'll be given a table, and you're going to have to calculate values, but you must know what the formulas are. Okay. So learn those formulas. That's why I put it there, so that you can see. And once you practice the table and you don't come to the right answer, then you must ask me so I can help you. Okay, Tom. Hello. Okay, let's go on. Then important, you've got to know the difference between short run and long run. Those two you don't have to worry too much about for the exam. Just know the difference between short run and long run. Short run is where at least one input is fixed and the rest can all vary, and long run is where all inputs are variable. The difference between those two is important. Okay, that's not so important. So remember we talked about revenue. I said revenue, cost or profit. So theory of cost, total cost, in a table you'll see total cost is normally made up of fixed cost plus variable cost. Now, in a table you can maybe just be given the total cost. Then you don't have to worry about fixed or variable. But if you're given fixed and variable, and you must calculate total cost, then you add those two together in a table. And then the marginal cost is exactly the same formula as at the top. I'll go to the table on costs as well, and you'll see. And the average, total average cost is just your total cost divided by the units or the quantity. So that the average is very easy. It could be marked for Mahala. If you just go through the table and calculate it, see if you can get to the values. And if you can't, you must come and ask me. Okay, this you've got to know. Accounting profit, normal profit, and economic profit. Okay, so economic profit is normally explicit and implicit costs together. I think this was asked in the assignment as well. So just know what total profit is, normal profit, and economic profit. That is just a summary of what it is. There's economic profit. You'll see it's implicit cost plus explicit cost. That's taken into account to calculate economic profit. Where with accounting profit, you only look at the explicit costs. That's the difference. It's important just to know the difference between the two. So total economic profit, implicit plus explicit, and accounting is only the explicit costs. Now here's a table. Okay, so if you're given a table like this, units of land, this is a fixed input, so that never changes. Okay, so that will always stay the same, so don't worry too much about that. What you must worry about is the change in the concept that's variable. So that's why you will work with the labor part. So the total product here will be given to you. Total product will be given to you. What you must calculate then from the total product, you'll be given the units and you'll be given the total product. What you must go and calculate is the average product. So the average product, as you remember, is the total product divided by the units. And forget this because this is just to show you that this stays fixed. So you'll take the total product, which is 16 divided by 1 is 16. And 44 divided by 2 is 22. So the average part is easy points that you just take the total divided by the units. And the marginal product is exactly the same. That's what you asked me now. You've got to know this formula. It's exactly the same. It's the total product, the change in total product, and the change in the quantity. So once again, you'll take the 16 to 44, and the 1 to 2 is 1. So the difference between those, it's 28 if you deduct the one from the other, and it's divided by the difference in that is 1. That's why you get to the 28. If this was the same like this, but here it was 1 and 3 and then 4 and 5 or so whatever. So say 1, 3, 6 or whatever. Let me just go back there. Then all you do is you take the total product. You deduct the 16 from the 44, which will give you 28. And then you see what the change was here. If it was from 1 to 3, then it's 2. Then it will be that 28 divided by 2, which would have given you 14. So for marginal, you work with that column, the change from one line to the next. And then you divide it by the change in lines of the units. Go and practice this. And the formula tells you what to do, so go and see if you can do that. As I said, average is quite easy. Okay, from this is... I see some students put this in the exam. It wasn't the right graph. But the product curve, what's important, you just need to know the shape of the product curve. It's normally from left to right, the marginal product, and the average product also from left to right. And at some point they cross. You don't have to worry too much about that for the exam. Marginal product, average product, the same as the previous curve. You just got to know the shape of the product curve is like that. And then this. I just want to get, I'll go back to the previous slide, but there's the product curve that I said you must know the shape. The cost curve is just the other way around. You just got to be able to show that the product curves go like that, and the cost curves is just the opposite way. But what you need to know is this slide 124. You may be given a graph like this with values, and then you've got to go and read the values off the graph. In your study guide, there's some calculations there that you have to just work through. So you may be given, this slide is important, go and work through it. The marginal cost and average variable cost, and you've got to say which is where. So go and see if you can, from this slide, go and see what is what. So at the price of 10 Rand, your marginal cost will be 100 Rand. At the cost of 6 Rand, your marginal cost will be 80 Rand. And at the price of 3.50 Rand, your marginal cost will be 60 Rand. You've got to be able to read this graph. So this slide is important for exam, I can assure you.
The question will be, what kind of a question?
It will be, the question will be from a given graph, go and interpret and calculate the values as asked. So you've got to show what the quantity is on the marginal curve if the price is 6 Rand or whatever. And you've got to show what the quantity or the output will be if the price is 10 Rand. So this, go look in your study guide in this specific part and see that you can calculate values from a graph like that. And that, I said, is just the different shapes. Study unit 9 is the market structures. Now, there are short and long questions about this. This is monopoly, oligopoly, monopolistic competition, perfectly competitive markets. You've got to know the differences between those two. And mostly what it is okay, so this is a perfect competition. You just got to know what perfect competition is. And that's not so important. Know what perfect competition is. There's a definition. Perfect competition occurs when none of the individual market participants can influence the price of the product. That's the difference between perfect competition and a monopoly, for instance. Monopoly, there's only one seller and they determine the price like ECO10A. So this table is important, that's why I put it there. Those are the differences between there's a different system. There's perfect competition, there's monopoly, oligopoly, and that's monopolistic competition and monopoly. And then there's the type of criteria that you need to measure it against. You may be asked to, given one or two of these, and asked to show what the difference is between the various systems. Maybe the difference between perfect competition and a monopoly, or the difference between perfect competition and an oligopoly. So just go and study this table. It's on slide 140. Is it 140? No. Okay, all you have to know from this slide is that under perfect competition, the average revenue will always equal marginal revenue. And that's the point of equilibrium. So, but I don't think there's a question about this in the exam. But just go and see what this slide says to you. That's the demand and supply, equilibrium, and in a perfect competition, average revenue is always equal to marginal revenue. Here's another table. It's exactly the same as the previous one. This is just about total revenue. Now, total revenue is just the quantity times the price will give you the revenue. So it's 50 times 600 gives you the revenue of 60,000. And then the marginal revenue is once again the total revenue. That line over there, the difference between those is 30,000. And then you go and look at the quantity. The difference between 50 and 100 is 50. So it's the 30,000 divided by the 50. That's why it gives you 600. And the same over there. The difference between 60 and 90 is once again 30,000. And the difference between 100 and 150 is 50. That's why it's 30 divided by 50. Just look at that's why I put the formulas in there that can help you. So practice these tables and learn the formulas so that when you get the table without the formulas, that you just know how to apply them. Okay, so this is not prescribed, so this is just for interest sake. Then it's just important that you got to distinguish between economic profit, normal profit, and economic loss. For exam purposes, I won't ask you the graphs. Just know what the differences are between those. It's all in the study guide, and it's also in the textbook. So this slide is important. Is it 144? Eh? Yeah. 144. Just know the differences between what is economic profit, what is normal profit, and what is economic loss. Okay, that's not important. Okay, this one is also not so important for the exam. You can go work through it. Marginal approach, this won't be asked. A table like this won't be asked. Just for illustration purposes. This is one slide 149. 148, sorry, 148. You just got to be able to illustrate where profit is increasing and where profit is decreasing. This is the marginal revenue and marginal cost of a firm operating in a perfectly competitive market. You may be given this graph, and then you've got to indicate where is profit increasing and where is profit decreasing. Always the marginal revenue is equal to the price. Anything above that, and the marginal cost curve runs like that, that's profit decreasing, and anything below that is profit is increasing. So just recognize that. And what you've got to know on this graph, if you're given a graph like this, is you've got to show where's the profit maximizing level of output. Now that's where those two curves cross, and just straight down. That is the profit maximizing level. So on this slide, take note of this diagram, and know that we know profit decreasing, profit increasing, and what's the marginal, the profit maximizing level of output. We're almost there now. Okay, so there's economic profit, normal profit, and economic loss. That was those previous ones that you can work through. And if you work through those, it will make sense to you. These graphs have been asked before in exams to show the areas. This exam, go through it because it will help you understand what economic profit and economic loss is. But this particular graphs won't be asked in the exam this time. Here's another curve that's quite important, slide 151. You have got to, if you get given a graph like this, what you've got to know here is which is the supply curve of the firm. Now the supply curve of the firm, if you're given a graph like this, is this whole curve here, this marginal cost curve, is the supply curve of the firm. You've got to point out and make it cross-hatched or just show it with a thicker line, which is the supply curve of the firm. So you may be given this, you won't be asked to draw it, but you may be given this graph and you've got to indicate where's the supply curve of the firm. Then market structures is monopoly and perfect competition. Just know what it is, look at those tables and distinguish between the different market systems. That's the most important part there. Yeah, this table is basically a duplication of that previous table I showed, but here it is also shown what the differences are, the number of firms, nature of the product, and the entry. And in the exam, you must link products to this. You must be able to recognize that for a monopoly, what type of product is it? Electricity, and it's water, and so on. And for perfect competition, it's any product. And for oligopoly, it's a few. And you must say it's homogeneous or heterogeneous products. So just make sure that you know the type of product and the nature of the product, that you know what that is. Okay, this is a continuation of that previous table. So you're got to know what the demand curve looks like. And okay, I can say this wasn't asked in the exam, this graph, but this is a short-run equilibrium of the firm under monopoly. If you read exactly what's going down there, then you'll see where the profit lays for a monopoly. But this wasn't asked in the exam. I just want you to know this slide, because later in economics you'll use it. In the labour market, there's not much asked about the labour market. There's only 1 or 2 short questions in this exam about the labour market. One thing that you've got to know, and I'll get to it now, study unit 11, I'll tell you which pages in the prescribed textbook the short question will come from. Okay. So you don't have to know all of that. You don't have to know all of that. And then I've given the exam question guidelines. This is the separate one that I will forward to you. Okay. So the presentation which you never got will have the old last exam questions. So if you go through last paper, use those. But these ones I'm going to send to you separately. And use these for this exam. Okay. So there it is there. I'm not going to elaborate on this. I think we did this in the study week. But this tells you exactly multiple choice questions is 5 marks. And what's important on this is you've got to concentrate on what I've said here. This narrows it down for you. So the questions will all come out of these concepts. So just make sure you understand the concepts. So the questions will be out of that. The same with the true and false questions is 10 marks. And it will come out of those concepts there. And I'll quickly just run through it in a bit more detail with you. And question 3 is 4 marks, which is a table, completion of a table. And then once again, there you'll see total, average, and marginal values. Those tables that I said, study those formulas. Here it is. All right. And yeah, I've actually given it away. It's about product, marginal, the product table. And the same question 6, remember I said it's 16 marks, definitions. And those are the focus areas where that will come from. And then question 5 is about, sorry, I said 24, it's 21 marks, supply and demand. Those concepts that I said to you, movement on shift, define law of demand, know what supply is, know what demand is, and be able to illustrate with a graph what it looks like. And then question 6 is about supply, production, as well cost and perfect competition. Once again, those are the focus areas. This question specifically, I said to you, go and study that graph where you can relate what's going on that graph. Remember a little while ago I said to you, so this is this question, and you'll be given a graph and you must be able to read the values. If you battle with the values or to read the values properly, you must ask me. Question 7 is 13 marks and it's about elasticity. Definition, formulas, calculations, drawing of graphs. Remember the different types of elasticities, 1 or 2 or 3 of those, and so on. Question 8 is production cost and revenue, and it's also a completion of a table. Production cost and revenue. Completion of a table in terms of cost, revenue, or that's what I said. The concepts are the same, but you'll be given a table and it will count 7 marks. And then question 9 is consumer equilibrium, that indifference theory, counts 10 marks. You'll be given a budget, and you must draw a budget line, and you must draw the indifference curve on it with show where consumer equilibrium is, and so on. So just go revisit that section. And then question 10 is 7 marks. It's about the market structures. Those are the last few that we said, monopoly, oligopoly, perfect competition, and those. Know the differences between those. So it's a definition, illustration, discussion, and product classification. In your study guide and in the textbook, it shows you what type of products go with what market system. I haven't necessarily in the presentation look at that, but go and look what type of products go with what type of market system, and give an example. That you are going to get that in the exam. Summary of the exam. Just a bit more breakdown of the exam. Okay. So question 1 is the 5 marks. It's the multiple choice questions. It's about the definitions of microeconomics, macroeconomics, economics, and so on. The circular flow table. Remember I said to you I may give you a graph of a circular flow between production, spending, and income, and you've got to show the arrows what's happening between that. Then the marginal revenue. When does a firm shut down? There's a statement. What I can do, what I'll do for you is I will put this on an email and send it to the students. Okay. But I'm just quickly going to run through it because our time is finished. So what I'll do is I'll send it to you, what I've got here, and then you can go and look at it. Has everybody completed the class list? Yes. Okay. Okay, so under the multiple choice questions, cross-price elasticity is important. Definitions, as I said, microeconomics, macroeconomics, marginal revenue concepts, and the shape of the PPC curve. So under multiple choice. And then for 10 marks is true and false questions.
That's question 2.
Yeah, total economic accounting profits, and that is important, as I said, Nana. Price elasticity values, less than 1 or larger than 1. Economic costs, you're going to have to go and look at. Then price elasticity of complementary goods is important. Okay, this I'm going to send to you in any case. Eh? Then what I've done here, I don't need to do this, but I want to give it to you so that you know what to focus on. So it's important, but I'll quickly run through it and then I'll mail it to you. Then you've got to know what oligopoly market structure stands for. Oligopoly market structure and a monopolistic competition structure. Product and cost curves and the law of diminishing returns. So you must know what the law of diminishing returns is. And know those different types of profits: economic profit, accounting profit, and economic loss. You've got to look what marginal, the marginal revenue product. That's pages, I'll put it in, I think it's 113 to 114, but I'll put it the prescribed textbook. It's called the MRP, the marginal product labor curve. It's a true and false question, but I'll indicate the pages to you. Okay, so for question 2 then is that table which I said. And it's all about product, marginal product, average product, total product, and so on. And for question 4 is the definitions for 16 marks. So that could be basically any definition, but I think on the right-hand side of what I've given there narrows it down for you what you must look at. And then question 5 is supply and demand. Counts 21 marks as we said, and I think I've indicated what you must focus on. Question 6, 7 marks. It's a graph where you've got to relate certain values from that I've showed to you. That's important. That's what it's about. Then question 7 is 30 marks, elasticity. As I said, it's a graph, percentage changes, the values and definitions of it. And question 8, also for 7 marks, is a table. And I think we did discuss it. It's the revenue cost or product concepts. And focus on the marginal revenue. If you can't do that one, the average calculation is easy, but if somebody battles with a marginal calculation, you must just come and ask me. I'll also put it on the group out for everybody to see how to calculate that properly. Question 9 is about indifference curves. I said you'll be given a budget. You must draw the budget line and the formula to calculate the slope of the budget line, and then draw the indifference curve on that indifference diagram and show where's the consumer equilibrium. That 10 marks. Then question 10 is for 7 marks. That's the different market systems that we did at the end. But go and look in your material and couple a certain product to a certain market structure. Because you may be asked to give a table of a market structure and give a type of a product in that market structure. Name the different market structures and give a product for each of those market structures. Okay, I think that concludes it. Now, I'm always available. If you people want to, you can come and see me anytime. And I hope we can get you all to pass and you two to pass well.
I only need 50%.
And the two Avis ladies must,
I don't need more than that.
the two Avis ladies must get distinctions. So.
Yeah.